All right, this is the beginning of Chapter 9, Liabilities. You can see the objectives here. Make a note, 9.2, we're going to skip the retirement of bonds, and you're going to skip convertible bonds. And you're also going to skip section or objective 9.5. All right, so we're going to go, the liabilities, the way this is structured goes from current liabilities, then we're going to get down to the long-term liabilities. So first we're going to consider current liabilities that have certain amounts. So we have accounts payable, notes payable, sales tax payable. There's lots of different items that can fit in here. But the sales tax one is here because it's a little bit of a unique situation. And what's unique about it is we have the payable, but no expense. Think of it. If you go to a store, buy whatever. You buy a computer, you buy shoes, you buy anything, you're going to pay some sales tax. Well, you're paying the tax. The corporation is not paying the tax. They just collect it and then send it to the government, remit it to the government. So at the register, they get $100 from the customer, $92 is sales revenue, and $8 of that is a payable. But there's no debit to expense because later, when they actually pay it, they remove the payable and they just credit cash. So sales tax doesn't, unless it's the company buying something, and then it wouldn't be a payable, be paid. But when a retail operation collects sales tax, it's not an expense to them; it's expense to the customer. All right, so that's a little bit different of a situation where you have a current liability increase, but no offsetting debit to expense. That's just in the case of sales tax and some other rare instances, but sales tax is a good example of it. All right, here's another one that we're going to get into the details. You've seen this one in earlier chapters. Salary expense, we're going to break it down a little bit. And, you get a paycheck, and if you were like me and you got your first job and your first paycheck, you're like, what is all that stuff that they took out of my paycheck? I thought I was earning whatever, $8 an hour or whatever you're getting paid. And it's nowhere near $8 an hour. Well, from a corporation's perspective, they have a salary expense, but you might have some income tax withheld. So they'll credit the income tax payable that they'll have to send to the IRS. And then there's also an employee and employer portions of Social Security, and then other things we didn't put in here, Medicare, is a little bit, but we're not going to get that into it. We're just trying to say there's aspects of the paycheck that increase liabilities that don't go to the employee. Here's the part that goes to the employee, which would be their take-home pay. The $6,500 is the take-home. But these are all being paid on behalf of the employee, right? So if you have too much withheld for the IRS, you get that back at the end of the year, and hopefully Social Security you get back when you retire, or not hopefully when you're disabled. So that's just a little deeper dive on salary expense. The salary payable is less all these other payables to government entities. Here's interest expense and interest payable, which we've already seen in other contexts. But I wanted to put in this current portion of long-term debt as another detail. So if you have a 5-year debt, there may be part of it that's due in the second year. If it's due with any part of long-term debt that's due within a year, will be reclassified as a current portion of long-term debt. All right. So this company, they have 100,000, 10-year, 10%, long-term debt. It's in its 5th year. In the 5th year, they have to pay down $10,000 of principal in addition to the interest. So that would be on January 1 of 2005. So they'll still have the interest expense and interest payable as usual, and there's no new payable because you have note payable already, but you'll have to take $50,000 of that principal, and there'll be a memo entry, which will be disclosed, and the current portion also will be disclosed in the footnotes. But you will in fact reclassify $50,000 of the note payable into current liabilities. Sometimes it's other liabilities. Sometimes, if it's large enough, it'll have a line that says current portion of long-term debt. Okay, so current portion of long-term debt, you might get where that will come in as a practical matter in a test is you might get a question about what part of this goes to current liabilities, or here's some long-term debt, part of it's due this year, what's total current liabilities? Here's another current liability with certain amounts that you've seen in earlier chapters, but unearned revenue. Just to review this one, do another brief example. Cost of insurance, they receive payment of $12,000 for the next year, and they get it on July 1 of 2001, and we're asked to record the adjusting entry. So $12,000 for 12 months equals $1,000 per month, and it's on July 1, so that's 6 months this year. 6 times 1,000 equals 6,000. All right, that's where the 6,000 came from. So when when the company receives the premium, they have received the cash, and then they have a current liability called unearned premium. As time passes, when they do the adjustments, they'll recognize part of the insurance revenue, and they'll reduce the liability. Okay, so this accrual is actually a deferral. This accrual accounting is a deferral because there's cash now and revenue later. All right, so that is all for the current liabilities with certain amounts. We're going to move on to estimated current liabilities in the next video lecture.